Hello again. Thank you so much for watching. Today, we're going to be discussing the topic hard money, what that means and how it pertains to you as a commercial loan broker or a borrower. So before we get started, if you would please hit the subscribe button and the notification bell. It does help us in those YouTube algorithms to get out there. And then also, if you already haven't done so, check out our Patreon, a lot of exclusive content that really helps our commercial loan brokers get their business to the next level. All right, jumping right into it. Hard money. So what is hard money? I mean, hard money is a very convoluted term, and most people don't know what it truly means. And I can frankly say there's no clear definition of the term hard money. There's no definition out there that says, hey, this is exactly what it is, A, B, and C. But what I can tell you based on my experience over the last 7 years is just this basic definition right here. In essence, hard money is short-term loans. So loans that are short terms, we're talking 3 to 6 to 12 months, high interest rate. So the rate's somewhere between, 10 and 15% a majority of the time. And then finally, high fees. So high fees would be, high costs on the origination points on the front end, maybe even high costs on the appraisal. And sometimes there's even upfront costs just to get the loan started. So the idea here is it's just hard to repay the loan without a clear exit plan. It's hard money. It's short term. Short terms mean you gotta have an exit plan. It's high rate. So it's going to be harder to repay that money because the payments might be a little bit higher. And then finally, high fees. So it's hard to get into the loan because you're going to have a lot of fees on the upfront or at closing. There's going to be a lot of lender fees. So I think that's why they termed it hard money. It's just hard to repay without a clear exit plan and without a clear entry. It's going to be hard to even get the loan. Now, typically you're going to see hard money loans when someone is asking for a bridge loan or they're asking to like fix and flip a house or fix and flip a commercial property. That's when you hear the term hard money loan. These bridge loans, these fix and flip loans, these are typically going to be short terms, high rates, and high fees. Now let's just jump into the positives and the negatives for hard money. There's a real stigma out there about hard money. And we're just going to go into the positives and the negatives here and hopefully break some of those stigmas. So first thing, let's just jump into the positives because frankly, there are plenty of positives on why someone would take a hard money loan. So number one, fast closings. So there are a lot of deals out there that require a fast closing. For example, if you have a property that's going up for auction, it's short sale and it's going up for auction. This is one example where it's like, hey, you have to give us the money right away. So fast closings, hard money can close. Sometimes hard money can close within 24 hours. You'll take the hard money lender with you to the auction. And if they like the property, they will actually drop the money on the table right there, buy it at the auction for you. But I will tell you, most hard money lenders will say, hey, we can close within about 7 to 14 days, because a lot of times they're going to require some sort of appraisal that gets done. But still, 7 to 14 days, much faster than the 30 to 60 days that you'll see with a conventional. Next big point is hard money normally covers the purchase of a property as well as the rehab of the property. So typically you see around 75 to 80% of the purchase price and then 100% of the rehab money. Most lenders do not provide rehab money unless you're a hard money lender. Short term, we're going to issue you a 12-month interest only loan, and we're going to also throw you some money that's going to help with the rehab. That's going to increase the equity that you're going to have in the property, as well as the lender. The lender wants to have equity in the property too, so they're happy to give you rehab money. Next big point is there's high LTVs. I know I mentioned 75 to 80% LTV on purchase typically, but sometimes you can get 90% on the purchase price. And when I mentioned 100% on rehab, that's very common. These hard money lenders are always willing to give, well, not always, but a lot of times they're willing to give 100% of the money on the rehab side of the project. So if you have a purchase of $100,000 and 50,000 of it's rehab, the lender is going to be willing to give you all that rehab money a lot of times. So there's really high LTVs with these hard money loans. like I said, 75% on the purchase, up to 90%, and 85 to around 100% on a rehab. So I already hit those points. Now, jumping into it, a lot of hard money lenders do not have minimum FICO score requirements. So FICO scores, that's something that will stop you from getting a loan from a lot of these conventional lenders, or even these soft money lenders that underwrite kind of like a hard money loan, but they issue these longer terms. They're going to have higher FICO score requirements. So hard money loans, sometimes they don't even have any FICO score requirements. So if you're someone who had a BK, or is just kind of your FICO score is struggling for some reason, your borrower's FICO score is hit for some reason, hard money is always a good go. Minimal experience required. So again, it's just like FICO. So FICO is driven by your credit history, right? Now, in this case, there's no experience required. A lot of hard money lenders are cool with lending to amateur investors. The LTV might be lower for an amateur, but they're still willing to lend to them. And then finally, interest-only payments. If you have a property and you're looking to fix it up, or buy it, fix it up, and sell it, there's no sense in making payments on principal, interest, taxes, and insurance. On a hard money loan, it's interest only. So you're only making payments towards that interest. So it saves you a lot of money, not having to pay taxes, not having to pay insurance, not having to pay, well, you will have to get insurance, but not having to pay the insurance on your monthly payment. And of course, not having to pay your principal. That's just, why would you have to pay principal if you're going to pay the loan off in 12 months? Now let's jump into some of the negatives. So obviously a short term is going to be a negative. These 6 to 18 month terms, what that means is the interest only loan for 6 to 18 months. And at the end of the term, the borrower is going to demand repayment. So that's called a balloon payment or a balloon loan. So, short term is obviously a negative. It's always, you just need to have a very clear exit strategy, just like we talked about in the first slide. The next negative would be a high interest rate. Obviously, nobody wants to pay a high interest rate, but considering that the lender is providing a very short term, they're expecting a higher interest rate because they're not going to hold on to the note for very long. 6 to 18 months, they're going to want a higher return on that money that they're investing with you. High fees, 2 to 6 points is typically what you're going to see from a hard money lender. So because you're buying a property that's most likely in some sort of debilitated condition, they're going to want you paying some points up front just to kind of cover them, in case they can't get out of the loan in the future. In case you might fail and they have to short sell the property, they have to foreclose on you. This way, they're at least getting something back in this high risk loan that they're investing in. Unforgiving lender. So unforgiving lender, what that means is at the end of the balloon payment, let's just say it's short term. Let's just say you go 6 months and you can't sell the property and you can't refinance with anybody because the property is in such a bad condition. These lenders will often default because they want that balloon payment. They need that money back so they can reinvest it or give it back to their investors. So in this case, lenders will often default on you. And you got to remember, default interest in most states is going to be between 18 and 24%. So they're really unforgiving. So it's a hard money loan. You need to have a clear exit strategy. You got to remember that point. And then finally, they have this term predatory lending. Like I said at the beginning of this slide, there's a very bad stigma with hard money. It might be called predatory lending. That's the negative. But you just got to remember, if you have a clear exit strategy, look at all the positives on the left-hand side. They close quickly. They'll buy on a property that's distressed. They'll give you money for rehab, high loan to values. So technically, it seems like actually pretty fair deal. Sure, the points and fees are higher, but there's all these benefits that are coming with the loan. So don't be scared by this term predatory lending. If you're an investor, you have a clear exit strategy. It's really not a predatory loan. You just have to understand what you're getting yourself into, or what you're getting your borrower into. Let's jump into the next slide. So we're going to jump into a hard money scenario. I'll try to make this as quick as possible, but it is pretty detailed. So let's just say we have an inexperienced borrower. He's seeking funds to purchase a distressed property and it's off market. They want to rehab the property and they plan on selling the property within 9 months. So this is a perfect scenario where you're going to say, hey, you're a perfect fit for a hard money loan. 6 to 12 to 18-month loan that's going to involve rehab. So let's go into the borrower's actual request, and then we'll jump into the actual terms that the borrower is going to see from the lender. So the borrower's coming in, he's saying, hey, I need 100% financing to buy this house. The purchase price is $200,000. I need $50K of rehab, and the after repair value is going to be $300,000. Oh, and by the way, I need to close in 10 days. So a lot of times you're going to hear borrowers kind of asking for the world because why not? Why not ask for as much as you can get, right? So obviously this is a bit of a stretch, especially considering the borrower is inexperienced, right? Just like we went over in the first in this last slide, they're inexperienced. So let's jump into what type of guidelines an underwriter or a lender would provide for a request like this. So most likely the lender is going to counter with something like this: 85% loan to value on purchase. So they'll say, hey, we'll give you 85%. I know you want 100%, but we'll give you 85%. So we're asking you, borrower, to come in with at least 15% to kind of split the risk with us on this deal. And then they will also say, most likely, hey, we'll give you 100% of the rehab though. So all you got to do is come in with 15% of the down payment on this loan, and we'll give you 100% of the rehab. Now that's a $220,000 total loan amount. Now keep in mind, there is going to be interest on the loan. 12% interest seems pretty fair, especially for an inexperienced borrower. And that's pretty common with hard money loans, 12% interest. It will be a 12-month interest only term. Very common. This is what you'll probably see if you're trying to place a loan like this. And then finally, the borrower will have to come in with points. So 3 points is pretty common from the lender. And if you're a broker, you need to throw your points on top of this, of course. So whether that's 1, 2, 3, 4, however many points you've agreed to with your borrower before seeking a lender for them. And then finally, I know the borrower might want to close in 10 days, but you need to make sure your lender knows that they need to close in 10 days, but make sure the borrower knows, hey, it could close within about 14 days. So if they need to get an extension on the purchase contract, then that's something they might have to do. So these are just some examples of what a borrower might come to you asking for and what a lender is most likely going to be able to provide to them, or you as a broker are going to be able to give them. So it's very important not to bow to the borrower's request and just disqualify all these lenders because none of the lenders can fulfill the borrower's request. It's better to actually know what the lender is going to provide before you speak to a borrower. And when a borrower makes the request, you need to kind of bring them back down to earth and say, hey, I know you want all this, but this is most likely what you're going to see in a market like this. So anyways, just a couple of examples of what you're going to see from a borrower and then from a lender's offer perspective. All right. A couple other hard money scenarios where you hear the term hard money. Number one is a bridge loan. So bridge lending is typically going to be on an existing commercial building has some sort of debilitated condition, and they just need some cash out on that building to restabilize it, to rehab it, and get renters in there. So that would be, a bridge loan is also, you could also consider that a hard money loan. Also, ground up construction is going to be similar to a fix and flip, but obviously it's going to require more experience. So this is a scenario where a borrower comes to you and says, hey, I have a plot of land. I want to build a structure on it and I want to sell it. That's going to be a hard money scenario, but the lender is going to want some sort of experience to see that the borrower has built or developed property in the past, so they're not risking too much with an inexperienced borrower. And then finally, hard money scenarios are very good, but only for instances where it's not a primary residence. If a borrower is trying to get a loan on their primary residence, they will not qualify for a hard money loan. And that's because hard money loans aren't regulated by the TILA and RESPA rules that have been put in place. So basically what that means is if a borrower wants to live in the property that they're requesting this loan for, that's a no-go. They would have to go more of a conventional or conforming loan route if they want to do that. So just remember that point. Borrower wants to live there. Hey, I probably can't broker to you because I do commercial loans only. Unless you're a residential loan broker, then you're good to go. Finally, who's it for? I know we've kind of gotten into this already, but let's just jump into it. Just to define just to hone in on the definition. So, hard money loans are typically going to be for your real estate investor who has a clear exit plan, and it's typically going to be used for your bridge loans, just like we talked about, or your fix and flip deals. And then obviously, it's got to be good for the market. And it can be bad for a borrower who doesn't really have a good plan. So you just got to make sure the borrower has a good plan, and and they're a real estate investor. They're not planning on living in the property, and we're good to go. So hopefully you guys drew some value from this video. I thank you so much for watching. If you haven't already done so, please hit the subscribe button and the bell. It helps our YouTube algorithm. And then also, if you haven't checked out our Patreon, we do post these slideshows there, so you can actually download the PowerPoint itself. And we post a lot of exclusive content that you won't see here on YouTube. It really helps our brokers out. Thank you so much once again, and we'll see you next time.